The majority of Bitcoin buyers are positioned correctly in the asset and incorrectly in their reasoning. That distinction matters more than it appears. Because reasoning determines behavior under stress, and behavior under stress determines whether a position is held through the structural environment that makes it valuable or liquidated precisely when its value is most asymmetric. The observable mismatch is this: Bitcoin's price action is primarily driven by retail and institutional capital motivated by return expectations. The narrative is speculative: buy now, sell higher, repeat. But the structural signals beneath that narrative tell a different story. Long-term holder supply continues to expand, exchange reserves continue to decline, self-custody adoption continues to rise. The capital that understands Bitcoin's actual function is not trading it, it is removing it from circulation. Two distinct populations are operating in the same asset simultaneously. One is buying a volatile return vehicle correlated to global liquidity cycles. The other is acquiring a non-sovereign monetary instrument outside the counterparty stack of the financial system. They hold the same asset, they are not making the same decision. And the divergence between those two populations is one of the most structurally significant signals in this market. Understanding why the speculative thesis misframes Bitcoin requires understanding the macro liquidity environment in which Bitcoin operates and what that environment is structurally producing. First, global net liquidity has entered a structurally ambiguous phase. Following the aggressive rate normalization cycle that began in 2022, major central banks face a compressed decision space. Maintaining elevated rates accelerates sovereign refinancing stress as debt issued at near-zero rates rolls over into a higher-yield environment. Cutting rates prematurely risks re-accelerating inflation before it is structurally contained. Historical analogs from the 1970s demonstrate that premature easing following an inflationary episode produced a second, more entrenched inflation cycle. The rate environment will remain constrained and contested, not cleanly easing, not cleanly tightening. And that ambiguity is precisely the environment in which assets with fixed supply characteristics historically demonstrate countercyclical value. Second, fiscal expansion is operating independently of monetary tightening across major economies. In the United States, structural deficits are projected to persist regardless of the rate environment, requiring continuous treasury issuance to fund the gap between expenditure and revenue. That issuance competes with private capital for allocation. It puts upward pressure on term premiums, and it produces a slow but persistent erosion of purchasing power that does not appear in monthly CPI readings, but compounds structurally over multi-year horizons. Real yields, the true measure of monetary friction on savings, have remained negative on a structural basis for the majority of the post-Minus 2008 period. The purchasing power cost of holding cash is not theoretical. It is a documented, recurring feature of the current monetary architecture. Third, dollar dominance is structurally contested for the first time in decades. The weaponization of SWIFT access and dollar correspondent banking as geopolitical instruments, most visibly in the 2022 sanctions response to Russia, has accelerated the diversification impulse among sovereign reserve managers globally. Central banks in emerging markets have increased gold purchases across multiple consecutive years, a behavioral signal that reveals a preference for reserve assets that carry no counterparty jurisdiction risk. Bitcoin shares that characteristic at the protocol level. The institutional adoption curve for that characteristic is early. The structural incentive driving it is not. The structural implication: the macro environment does not favor passive cash holdings, does not favor long-duration fixed income at current real yield levels, and does not offer a clean liquidity easing cycle that would benefit risk assets uniformly. It rewards structural clarity over reactive repositioning. The institutional positioning data reveals a bifurcated market, and the bifurcation maps directly onto the two-population dynamic established earlier. First observable signal: spot Bitcoin ETF inflows represent the largest and fastest accumulation of Bitcoin by regulated vehicles in the asset's history. The pace of that accumulation compressed the available liquid supply on exchanges faster than comparable institutional entry events in prior cycles. The interpretation is not that institutional capital has validated Bitcoin's speculative thesis. It is that institutional capital has created a regulated on-ramp for exposure to Bitcoin's return profile within existing portfolio mandates. The ETF buyer is accessing the liquidity cycle trade. They are not acquiring direct ownership of a non-sovereign monetary instrument. The custodial structure of the ETF product means they have, by definition, reintroduced counterparty exposure into a position designed to eliminate it. Second observable signal, corporate treasury allocations to Bitcoin reflect a different thesis entirely. These actors are not seeking near-term return. They are making a balance sheet decision, replacing a depreciating cash reserve with an asset whose supply cannot be expanded by any counterparty. The incentive is not speculative, it is defensive, and the financial logic is identical to the individual sovereignty thesis. When the monetary instrument you hold can be debased by a third party at will, the rational response is to hold a monetary instrument that cannot. Third observable signal, stablecoin supply expansion, continues across both regulated and decentralized rails. The expansion is concentrated in jurisdictions experiencing currency instability and in DeFi protocols offering yield on dollar-denominated assets outside the traditional banking system. Users reaching for stablecoin access are not speculating. They are solving for monetary stability outside a failing local system. The path from stablecoin adoption to Bitcoin self-custody is the natural second-order step, and the on-chain data confirms that cohort is moving in that direction across multiple emerging market geographies. The interpretation across all three signals. The institutional layer is primarily accessing the speculative return profile. The structural layer, corporate treasuries, self-custody adopters, and emerging market capital fleeing local monetary failure, is accessing the sovereignty infrastructure function. Both are growing. The latter is growing in environments where the former does not yet operate. The derivatives market provides the surface read on sentiment. The on-chain data provides the structural read on conviction. They are diverging, and the divergence is the most analytically dense signal in the current environment. First derivatives signal, open interest in Bitcoin perpetual futures has expanded alongside price appreciation across this cycle, consistent with the historical pattern of speculative leverage building into liquidity-driven uptrends. Elevated open interest relative to spot market depth creates reflexive conditions. Price moves in either direction are mechanically amplified by cascading liquidations rather than fundamental reassessment. A significant portion of observed price volatility in this cycle is leverage-driven, not thesis-driven. Second derivatives signal. Funding rates have oscillated between elevated positive territory during speculative surges and mean reversion during deleveraging events. Sustained positive funding compresses the return available to long holders while simultaneously increasing the structural fragility of the position stack. When leverage unwinds from elevated funding regimes, it does so discontinuously, not gradually. The most significant price dislocations occur not at the moment of maximum fear, but at the moment of maximum leverage. First on-chain signal, HODL wave data continues to show expansion of long-term holder supply, coins unmoved for more than a year, even as short-term speculative positioning increases. This supply bifurcation is the behavioral fingerprint of the two-population dynamic operating simultaneously. The long-term holder cohort is not responding to price volatility with liquidation. It is responding with accumulation during drawdowns and patience during appreciation. That behavioral profile is not consistent with a speculative return thesis. It is consistent with a conviction thesis anchored in a structural function that does not diminish with price fluctuation. Second on-chain signal, exchange reserves continue trending toward multi-year lows as a persistent directional trend. Supply moving from exchange custody to self-custody wallets represents realized demand capital that has not just been allocated, but structurally committed to a non-custodial holding architecture. The expected value of that commitment increases in direct proportion to the expansion of monetary control infrastructure, capital restriction policy, and banking system fragility globally. The convexity insight, the speculative population faces symmetric risk. Bitcoin can reprice down as readily as it reprices up in a liquidity contraction. The sovereignty infrastructure population faces asymmetric risk. The structural value of a non-sovereign, non-custodial monetary asset increases in exactly the scenarios most damaging to traditional financial holdings. That asymmetry is not priced into either the market narrative or the surface-level derivatives data. It is only visible when you decode the behavioral layer beneath the price. The central error most Bitcoin buyers make is not a financial error. It is a definitional one. They are buying a return vehicle and calling it a sovereignty tool. Those two framings carry different time horizons, different behavioral requirements under stress, and different risk management architectures. Conflating them produces a position that is neither optimized for return nor structured for sovereignty. For the capital positioned for the liquidity cycle trade, the risk management framework is dynamic, sized to the liquidity environment. Monitor derivatives signals for leverage accumulation. Maintain allocation discipline against emotional anchoring to prior price levels. This is a legitimate framework. It requires continuous macro awareness and the discipline to reduce exposure when the liquidity backdrop deteriorates, regardless of narrative momentum. For the capital position for the sovereignty infrastructure function, the risk management framework is architectural, not dynamic. The allocation is sized to the portion of capital whose primary requirement is preservation outside the monetary debasement mechanism and outside institutional counterparty exposure. It is held in self-custody. It is not sized to short-term liquidity needs, and it is not managed against price fluctuation because price fluctuation is irrelevant to the structural function the position is performing. Most Bitcoin buyers skip the definitional step entirely. They respond to price, narrative, and social signal, and they call the result a strategic position. A strategic position begins with a single question. What is this asset actually doing inside my capital structure? What risk is it hedging? What function is it performing? And does my holding architecture match that function? The answer to that question determines whether a Bitcoin position is a speculative bet that will be abandoned at the first significant drawdown, or a structural allocation that compounds in value precisely because the conditions driving its necessity are not cyclical. They are architectural. This is 21 protocol. Freedom is not a feeling, it's a structure. If you don't build yours, they will build over you.